A happy new year to all our listeners and welcome back to the podcast from Morningstar UK, the leading provider of investment news, views and analysis. This week, we give you plenty to share in our guide to investing for 2019. Let's start with some stock picks for the new year. Killick & Co.'s Rachel Winter shares her 3 stock picks for January 2019, a mix of value bets and dependable equities, with our Morningstar Senior International Editor, Emma Wall.
Hello and Happy New Year, Rachel.
Happy New Year.
And what's the first stock pick of the new year?
Well, clearly the end of last year was quite difficult and we did have a lot of market volatility, a lot of very weak market indices. So we've been looking for 2 things. We've been looking for stocks that have come down quite a lot in value and now look very attractive, and also stocks that have held up quite well and haven't been that volatile because they just do feel a bit safer and a bit more defensive. So first of all, let's look at one that's come down a lot. And for us, one that's done that is Airbus. So that's off about 20% since its record highs. And Airbus, it really acts as a duopoly with Boeing. So there are really only 2 major aircraft manufacturers in the world, Aircraft and Boeing. Because of that, they really do have a lot of control over pricing. There's a lot of demand for what they do. And in fact, Airbus has got enough business to take care of it for the next 9 years. So people do tend to order aircraft very far in advance. And also, we just are seeing a lot of increase in air travel across the whole world, particularly in Asia. So we do think there will be quite an increase in future demand for what Airbus does.
Now, obviously, that stock has come down quite a lot, 20%. How can you be assured with a stock like that it's not a value trap and is just good value?
I think you've got to look at what the wider market has done. So the wider market is off at least 10%, so Airbus isn't down a huge amount more than that. And in the recent market volatility, we did see the industrial sector, which Airbus is in, that was hit particularly hard. And I think that was just a bit of concern about potentially the trade war between the US and China, and also rising interest rates because these companies do sometimes need to borrow quite a bit of money. So I think those are probably the reasons, but for us, they're not major concerns. And at these levels, we do think the stock looks very attractive.
And what's the second stock pick today?
So second stock is one that has been a bit more resilient. So this is a company called Medtronic. It's American and it's a medical device manufacturer. And in fact, it's one of the largest ones in the world. And actually, this ties in quite nicely with the big announcement yesterday that came out from the NHS. So they've announced their new budget plan, so how they're going to spend their new £20 billion of budget. And what they've said is they want to spend more money on preventing illness rather than curing it when it happens. So rather than just giving people loads of expensive drugs when they're sick or letting them get so sick they need to go to hospital and then it becomes very expensive to treat them, I think the NHS is going to work more towards preventing illness from happening, and that will require more medical devices, which is what Medtronic makes. And an example is diabetes. So rather than giving people drugs or allowing them to have to spend time in hospital because their diabetes has got so bad, if you can give them a glucose monitor that they can use on an ongoing basis, that will help them to manage the condition, and hopefully you can avoid any hospital stays, and over the long term the NHS should save money. So that's really where we think healthcare is going in the UK and also globally as well.
And what's the third and final stock pick?
Third one is another one that's been quite resilient, and that's American Waterworks. So as you can tell by the name, it's another American company. It's held up very well in the recent market volatility, and it's the largest water and wastewater company in the US. So what it does is it manages a big collection of pipes and wastewater treatment works. And how it works in the US is each utility company has what's called a regulated asset base. So they have to work out the value of their regulated assets, i.e. all of their pipes, their water pipe networks, wastewater treatment facilities, and they are allowed by the regulator to make a specific return on the value of those assets. And that return in the US is 9.5%. So this company is allowed to make a return of 9.5% every year. And for us, that's very attractive. That's very high for a company that's as relatively safe as a utility business.
Now, you and I have talked in the past about the UK utility sector. It's a sector that is vulnerable to political risk, in particular a Corbyn government. With US utilities, is politics a risk, a concern? Could Trump influence the sector?
I think Trump probably poses a benefit, actually, because he's so keen to spend more money on infrastructure. He hasn't yet been able to do that, but if he does, I think that would be good for American Waterworks. And even without him, they are still increasing the size of their regulated base every year, and that's enabling them to make more money every year. So for us, this is quite a good alternative to a UK utility company.
Rachel, thank you very much.
You're welcome.
Are you ready to invest in 2019? State Street Global Advisors Kevin Anderson says 2019 will be volatile, but there will also be opportunities for investors who are ready to pivot.
Hi, Kevin.
Hello.
So we're here today to talk about how 2018 has rolled out and what investors can expect from 2019, with one particular focus, and that's the trade war. It has particularly affected people here in Hong Kong, in Asia, dominated the headlines in 2018. Can we expect it to do the same in 2019?
As we walk into 2019, we actually have a moderate overweight to US equities. We're cautious on emerging markets, but reflect on the fact that valuations are actually pretty attractive. So, the trade war is certainly in the minds of investors, certainly in the minds of emerging market investors, but we don't think that should put investors off still seeking the strong fundamentals in the US market.
And of course, you mentioned there that valuations do look quite attractive in emerging markets because fear has sort of stoked a lot of pullback, hasn't it? And that's created opportunities.
Well, there's been a significant negative sentiment emerge in emerging markets over the course of 2018. I mean, we should reflect on the fact that emerging market valuations are actually not too far away from long-term averages in absolute terms. Relatively, though, compared to developed markets, they are looking attractive. China in particular, for a long-term investor who's prepared to withstand some more volatility, we think these are attractive entry points, especially into sectors like consumer discretionary.
Should we expect some volatility though? Because although they've pressed pause on the sort of trade tariff rhetoric, it is only pause. It's not an end to it, is it?
We certainly haven't seen the end, and there's a self-imposed deadline, if you will, for resolution, which is fast approaching. If the full set of tariffs were to be imposed by the US, we could see 2% come off GDP in the US and China, for example, and that would be quite significant. Our core view is that cooler heads will prevail, and we are seeing some signs of that with changes in auto tariffs, resumption of purchase of soybeans, for example, from China, but there is still a lot to negotiate for sure, and so volatility is likely to be a part of our landscape until we see resolution here one way or the other.
Now, some of your peers, to pick up on your point about that potential hit to GDP, are predicting a US recession for 2019. Presumably, with your overweight to US equities, you're a bit more positive on that market.
Well, our view would be at the moment that it really isn't over until it's over. And there may well be time for reflection as we get through mid-2019 that there is an opportunity to pivot from the US, where earnings are still strong, where fundamentals are strong, to markets that have been somewhat more beaten up and beset by political considerations. I'm not really just talking about US-China here, I'm thinking about Europe in particular, which is also looking very cheap, but beset by a number of really significant political challenges, and ultimately those challenges could dissipate and we could see opportunities. So be ready to pivot.
Kevin, thank you very much.
Thank you.
Our next guest, Sigma's Chief Investment Officer Tom Beckett, warns us that the upward rising markets of the past decade are over and that investors should prepare for a risky year ahead.
Hi, Tom.
Greetings, thank you.
So 2018 has been dominated by the US, both in terms of the macro stuff with the trade war and indeed Korea, and with the Fed rate rise potential causing volatility in markets and even in earnings, actually. US equities have been one of the stronger deliverers for investors. Going into 2019, can we expect this US dominance to continue?
I mean, US equities have almost been the only game in town for much of the year. Now we've seen quite a significant reversal in recent weeks and months. But I think as we move into next year, I think there definitely will be elements of a change. I can't see what we saw in the third quarter when the US just dominated and everything else did badly happening once again. I think those days are now behind us.
And so if the US is no longer going to be the driver of returns, where should investors be looking 2019 to deliver those opportunities?
Look, I think the US won't necessarily be a disastrously performing market or necessarily a strong outperformer. It it might well be in the mix. But I think if the scenario that we expect to take place, where markets are difficult next year, but you see some quite significant counter-trend rallies, for Choice, I think something's changed in the last 6 months. I think that the very enjoyable period that investors have had for the last 10 years is now behind us. Next year, I would expect there to be some downside pressure, certainly. And I think when markets rally, it is going to be led by the laggards of 2018. Asian equities could be a very good example of that. Things like European equities could see some counter-trend rallies. So I think the game has changed.
And how much sort of credence do you give to the fact that many people are predicting a recession for the US next year?
I don't think it's next year, but I think very much we believe that we're coming towards the end of this cycle. But, you know, in terms of baseball analogies, if we're in the ninth innings, we know the ninth innings can go on for quite a long time. And indeed, quite a few baseball games, much to the disappointment of many people, then goes into overtime as well. So I don't think necessarily a recession is imminent, but I think it's quite obvious the economy in the US has slowed quite considerably in the last few months. And there's lots of indicators pointing towards that. And I think we see a further moderation of growth next year before the end of the cycle comes quite quickly. And I think, you know, talk of recession isn't too far away, but I don't think it's as imminent as some people are suggesting.
Aside from the US recession and aside from the US equities coming off a bit, where are the main risks in 2019 for investors?
There's plenty of, well, there always is plenty of risk, but I think at this point in time we are monitoring a number of different things which could well cause problems. I think focusing on Asia in particular, my research suggests that actually we're going to see further earnings downgrades as we move through the first part of next year. You could say that the market has already reflected that, but I think earnings disappointments around the world could well be a factor as we move through next year. Now, obviously, in very recent hours, we've actually seen commentary from the Federal Reserve, which is, or from Jay Powell, which is less hawkish than people were perhaps previously expecting. So maybe the Fed isn't quite such a big risk. But I think investors might start asking themselves, if the Fed can't put up interest rates like they're projecting, what's wrong? Other risks, definitely Europe. I think people are understating the risks there. As I travel around the world, most problems always seem to me to come back to Europe. And I think that's still quite a big risk as we move to next year. And global geopolitics also present a risk. Now, on the flip side of that, you know, there's lots of risks to talk about. I think that asset markets have obviously reset valuations, and so that gives me a bit more confidence. And I'm probably find myself more confused than I have been in recent years, when 2016 really quite optimistic, last year optimistic but fading, this year cautious. Next year, I think confused is probably a message I would have.
Tom, thank you very much.
Thank you.
What will trigger an emerging market rally in 2019? This year, markets were dominated by politics and in particular the trade war. What can investors in Asian equities expect from 2019? Emma Wall speaks with Kim Do, head of Greater China Investments for Barings, to find out.
Hello, Kim.
Good morning.
So 2018 was very much dominated by politics and in particular the trade war. What can investors in Asian equities and in particular China equities expect from 2019?
2019, I think that hopefully we'll see some easing of the escalation of the trade war talk. And also hopefully we'll see the US Federal Reserve actually at some stage declaring that they have reached a neutral rate of interest rate. And that would be very helpful for Asia because, as you know, Asian markets really can't rise too much when the US dollar is strong and when the Fed fund rate is rising. But if the Fed fund rate was to pause and the US dollar were to come down a little bit, that would be very helpful for Asian equity markets.
And what about instruments that governments and indeed central banks are implementing here in Asia? Because it's not like the Bank of China or the Chinese government has been sitting back passively over the last year, is it? There has been some stimulus that's come through.
Yes, there has been. But I think that unlike the episode of 2008, 2009, when we had the gigantic fiscal package, and unlike 2015-16, when we also had another fairly big fiscal and monetary stimulus package, this time around, I think that President Xi and the State Council are a little bit more prudent about injecting too much stimulus into the economy because it may go into speculative areas like the property market or some other areas where the productivity is not very high or helpful. So that's why I think that they have been quite prudent about trying to inject or implement policies to help the economy. But definitely the impact of all these actions will translate into a slightly better recovery we think that the second quarter of next year we'll see a bounce in the Chinese economy from that time on. Yeah.
So, of course, active managers see turbulence such as we've experienced this year as an opportunity to buy, although individual investors often get quite scared during those times. What do you foresee in terms of volatility for 2019? More of the same, or do you expect it to be a little bit more positive next year?
We think that this year, as you said, was dominated by two very big things: trade war escalation and the Fed and the U.S. Federal Reserve. As far as next year is concerned, if the trade negotiations appear to actually be going quite well, because President Xi and China have been prepared to actually cut back on the U.S. autos tariffs and buy soybeans again. So this makes the U.S. farmers happier, because the U.S. farmers actually receive a subsidy from the U.S. government, but they don't want that. Farmers are very proud and independent people, so they want to actually sell things at market price and not relying on the government for subsidies. So I think that's a good thing. And also the fact that we have 90 days in order to try to negotiate, I think that's a good thing. So that will help to lower volatility somewhat next year. The second thing is the U.S. Federal Reserve. So if the U.S. Federal Reserve hits a neutral rate at some stage, it could be 2 rate hikes from now or 3 rate hikes from now. We don't know. But we think that at some stage, perhaps by mid-year next year, the Fed might say, okay, I think that we've done sufficiently now. So let's pause and see what the impact of all this on the U.S. economy is. So those two factors combined together, I think that should lower volatility at some stage in 2019.
Kim, thank you very much.
Thank you.
What should ETF investors expect in 2019? Jackie Choi, Director of ETF Research for Morningstar Asia, believes the focus should be on more exposure to mainland China shares, active ETFs, and a focus on ESG.
Hi, Jackie.
Hi, Emma.
Happy New Year.
Happy New Year.
So what can ETF investors expect from 2019? Let's start perhaps with China A shares, because that was a big story in 2018.
Big story in 2018, and it will be a busy year in 2019 again.
And that's because China A shares are being included in more indexes, aren't they?
That's correct. So last year, 2018, we had MSCI first included A share into their EM indices, and also global indices, obviously. And for 2019, not just MSCI would potentially increase their weighting in China A shares again, but also FTSE will be including China A shares starting from June. And then S&P will be including China A shares starting in September.
And so that potentially means a lot of investors who hold emerging market ETFs and global ETFs will see their exposure, their investment in mainland Chinese shares increase or even start investing for the first time.
That's correct, Emma. So anything that have like EM exposure or global, which includes EM exposure, will have a little bit of China A share onshore equity in there.
And what about active ETFs? Because we saw Fidelity launch an active ETF in Australia last year. That was a big news story. Can we expect to see more active ETFs launched this year in the Asia-Pac region and even globally?
Well, potentially. I mean, like for example, in Hong Kong, they have a revised regulation which allows active ETFs to be launched. But one aspect that I would add is that ETF is a distribution channel from my view. For active ETFs to be successful in the ETF space, they really need that sort of like a brand name and also familiarity for retail investors for them to be able to sort of get into that distribution channel to get to that to get into that fund.
And so really we're not going to see all funds then replicate themselves through an ETF distribution channel, maybe only some big famous ones.
I would think so.
And aren't there different rules depending on the different region as well, which may impact whether or not we see active ETFs launched?
That's a good question, Emma. I think, like for example, in the US, it is required for ETFs to publish their full portfolio on daily sort of frequency. That sort of like deters a lot of active managers to publish their full portfolio, which is their skills, right? So that limits the their will to launch active ETFs in the US or through other channels. But in other parts of the world, for example, Australia, they don't need that daily full disclosure. So that sort of difference changes the appetite for fund managers to launch active ETFs.
And what else can we expect from 2019? ESG is a growing theme in investment. Can we expect to see ESG ETFs launched, more of them in this year?
Well, we've seen quite some being launched in the past 1 or 2 years, especially in Europe. And I think this growing theme is a very big topic in the fund industry. Potentially, we can see more of these kind of ETFs in the region as well.
And is there an appetite for it? I mean, it's one thing for asset managers to be launching these ETFs. It's another thing for investors to be buying them.
Mm-hmm. Well, ESG is a very complicated topic sometimes because everyone has a different ESG in their mind, definition of ESG, what they want in the ESG. So whether or not packaged into an ETF is another topic for discussion.
Jackie, thank you very much.
You're welcome, Emma.
Disciplined investors always urge others to buy on the dips, but not all stock market falls create buying opportunities. Our next guest, Morningstar Investment Management's Dan Kemp, explains why a share price slump does not always mean buy.
There did not seem to be much Christmas spirit in capital markets in December, with most share prices falling between 3 and 8% over the month. In these situations, investors naturally look for stories to explain the falls, while market commentators seek to make headlines by making bold predictions about the year ahead. We don't have a crystal ball at Morningstar Investment Management and are naturally suspicious about stories that neatly fit recent market movements, as both approaches tend to encourage the behavioural biases that can lead to poor investment decisions. Instead, we focus on identifying assets that appear to be priced differently to a reasonable expectation of their long-term returns. As we look at the world through this valuation-driven lens, a few things become clear. The first is that a discount is not the same as a bargain. Savvy shoppers venturing into the January sales focus on purchases they need that are priced unusually cheaply. A discount on the previous price does not necessarily mean that something is cheap or desirable. Don't be that shopper that spends too much on something you don't need. To put this in an investment context, US shares are certainly cheaper than they were, but do not appear to us to offer good value. Second, the best bargains appear when something becomes unpopular and the seller simply wants to get rid of it to make way for the latest fashions. There appear to be few assets less popular than UK shares at the moment, and while they could not be described as a bargain, they are certainly more attractive than most other asset classes, as investors focus on the downside of Brexit rather than the long-term opportunities afforded by the underlying companies. Finally, remember that discounts are never a one-time event. Capital markets don't have closing down sales. As a long-term investor, you never have to pay more than an asset is worth, as you will always have an opportunity to buy it at a more attractive price. To do so requires the ability to think independently and be prepared to pick up bargains that others overlook.
Younger investors are urged to stay in the game when it comes to pension savings, ahead of their auto-enrolment minimum contribution jump due this April. You'll need to play the long game, says Morningstar's Emma Wall, to win with retirement saving.
Auto-enrolment was introduced in 2012. The initiative is designed to get as many people as possible into workplace pensions so that they can afford to fund a comfortable retirement. So far, 8 million extra people are in workplace pensions because of auto-enrolment, but this year sees some changes to the initiative. Last April, the minimum contribution rate for both employer and employee was 2%. Then last April, this rate was raised to 5%. And this April, in just a few months' time, the total minimum contribution will rise to 8%. This means a minimum of 5% from the individual, including tax back from the government, and 3% from their employer. This is quite a jump in minimum contributions, and the concern is that the so far very low dropout rates will rise. Those particularly at risk are those in low income categories and those at the beginning of their career. Particularly those in the beginning of their career should try not to be put off by volatile markets of late and the long journey ahead of them, because investing is a game and you have to be in it to win it.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.